Let me ask you a question that most financial advisors are too afraid to touch because it would expose how badly they have misled you. If you knew a fire was coming, would you wait until you smelled smoke to buy an extinguisher? Of course not. You would buy it the day you heard the word fire. Well, the fire is here. The 2026 silent depression has already burned through cash, bonds, and most stocks that do not have pricing power. And yet you are still sitting on dollars that are losing 5 to 7% of their purchasing power every single year. That is not an opinion. That is the Treasury's own inflation-linked bond data. So why am I telling you to move into real estate and gold right now? Not next month, not next year, but today. Because the window of opportunity for middle-class Americans to acquire hard assets at reasonable prices is closing faster than you think. Institutional capital is already rotating out of the Magnificent Seven tech stocks and into tangible, income-producing, inflation-resistant assets. By the time you see the headlines that say real estate and gold are the new safety trade, the prices will have already moved 20 to 30%. You do not get rich following headlines. You get rich reading the fire before the smoke. Let me give you a real example from a client I worked with in December 2025. His name is David, a warehouse supervisor in Phoenix, Arizona. David had $43,000 saved in a high-yield savings account, earning 4%. He came to me and said, "I am waiting for home prices to crash before I buy." I asked him how long he had been waiting. He said 3 years. In those 3 years, the median home price in Phoenix had gone from $420,000 to $560,000. His $43,000 in savings had grown to $48,000 with interest, but his down payment needed to buy the same house had grown from $21,000 to $28,000. He was further away after 3 years of responsible saving than he was on day one. That is the quiet tragedy of cash. You think you are being safe. You are actually being slowly robbed. So David and I made a different plan. We took $30,000 and used an FHA loan to buy a duplex for $410,000. His mortgage payment, including taxes and insurance, is $3,200. One side of the duplex rents for $1,800. The other side he lives in, but he could rent it for $1,700 if he moved out. His net housing cost after rental income is $1,500, which is less than the $2,000 he was paying for a one-bedroom apartment. The remaining $13,000 we put into a gold ETF and physical gold coins held outside the banking system. 6 months later, that duplex is already appraising at $440,000. The gold is up 9%. David is not a genius. David is not lucky. David simply stopped treating his wealth like something to protect and started treating it like something to deploy. The psychology that kept him waiting was loss aversion disguised as prudence. He was so afraid of buying at the wrong time that he never noticed the right time was already burning behind him.
Let me show you exactly why real estate and gold are not just good ideas, they are the only two asset classes that protect you from the specific mechanism of the silent depression. The silent depression is not caused by a lack of money. The Federal Reserve has printed more money since 2020 than in the entire previous decade combined. The problem is that new money does not flow evenly. It flows first to the institutions and the wealthy, who buy hard assets before prices adjust. By the time that money trickles down to your paycheck, the assets you need, housing, energy, food, have already repriced upward. Real estate protects you because you get to be the landlord, not the tenant. You get to raise rents when your expenses go up. You get to refinance when rates drop. You get to depreciate the asset on your taxes, even as it appreciates in reality. Gold protects you because the central banks of China, Russia, India and Turkey bought more gold in 2025 than in any year since 1967. They are not buying because they like shiny things. They are buying because they do not trust each other's currencies, and they do not trust the dollar's long-term purchasing power. When the people who print money start buying gold, you should pay attention. Here is the psychological barrier that is stopping you. Your brain thinks of real estate as too much work and gold as old-fashioned. That is not analysis. That is laziness dressed up as sophistication. The wealthy do not ask whether something is work or old-fashioned. They ask whether it has a 5,000-year track record of preserving wealth across every civilization, every war, every currency collapse, and every depression, silent or otherwise. Real estate and gold are not investments. They are survival tools for a monetary system that is slowly breaking. Stop and let me speak to the fear I know you are feeling right now. You are afraid of making a mistake. You are afraid of buying at the top. You are afraid of being the person who bought in 2026, right before the crash that everyone else saw coming. I understand that fear because I have felt it myself. But let me ask you a harder question. What if the crash never comes? What if real estate does not crash because there are 4 million fewer homes in America than there are households who need them? What if gold does not crash because every time the stock market sneezes, global central banks buy another 100 tons? You are waiting for a disaster that the data does not support. Meanwhile, the actual disaster, the silent erosion of your purchasing power, is happening right now while you wait. Your motivational anchor for today needs to be this phrase: I would rather own a piece of the earth than a promise from a government that cannot balance its own checkbook. Real estate is earth. Gold is earth. Dollars are promises. Promises get broken. Earth does not go anywhere. You do not need to become a slumlord or a gold bug. You need to become someone who allocates a percentage of every paycheck to things that cannot be printed, cannot be hacked, and cannot be taken from you by a software update. Start with 10% of your net worth in physical gold or a low-cost gold ETF. Start with a goal of owning one real estate asset that produces income, even if it is a small condo or a duplex in a secondary market like Indianapolis or Birmingham. You do not need to be rich to start. You need to start to become rich.
Here's your expert solution, broken into 3 steps that you can execute within the next 30 days. Step 1. Open a self-directed IRA or a solo 401k that allows you to hold physical gold and real estate inside your retirement account. Most Americans do not know this is legal. It is. You can roll over an old 401k into a self-directed account and buy a gold ETF, physical bullion stored in a licensed depository, or even a fractional share of a rental property through a platform like Arrived or Farm Together. This is how you move your retirement money out of paper assets and into hard assets without paying taxes or penalties. Step 2. Do what I call the rent replacement calculation. Take your current monthly rent or mortgage payment, multiply by 120, which is 10 years. That number is approximately what you will pay for housing over the next decade if you do nothing. Now, ask yourself, could I redirect half of that amount into a down payment on a small income-producing property within a 2-hour drive of where I live? If the answer is yes, you have your target. If the answer is no, you start with a gold allocation instead. Step 3, and this is the master key that separates the wealthy from the wishful in 2026. You must stop asking for permission. No financial advisor will call you to recommend real estate and gold because they do not make recurring commissions on those assets. No news anchor will tell you to buy because fear sells more advertising than empowerment. No friend or family member will validate you because they are trapped in the same silent depression, waiting for the same crash that never comes. You have to move alone, quietly, and with conviction. Put $10,000 into a gold ETF by Friday. Spend the next weekend driving through 3 neighborhoods within commuting distance of your city, looking for a duplex or a fourplex that cash flows at today's interest rates. Make an offer below asking. Get rejected. Make another offer. That process, not the outcome, is what transforms you from a victim of the silent depression into a survivor of it. The people who move now will look back in 2030 and not even remember what they paid because the cash flow and the appreciation will have made the price irrelevant. The people who wait will look back and wish they had listened to someone who told them the truth. I am telling you the truth. Move now.